Hello. Today, we're breaking down the US-China trade deficit in plain English. We will explore things like how trade deficits work, how they are financed, and what happens to a country when foreigners start owing more of its assets. Does a trade deficit make America weaker, or is it just part of the game, meaning that it's part of global trade? Let's find out. Every year, the US buys hundreds of billions of dollars more from China than what it sells back. But what does that trade deficit really mean? Could it be just a number on the balance sheet? Or could it be a sign that wealth, power, and ownership are shifting across the Pacific? You have probably heard politicians talk about trade deficits like they are some sort of scoreboard. When the deficit grows, they claim the country is losing. But could that be true? In a free trade world that we lived in? What does it mean when a country imports more than it exports? And how does the money move across the borders to make up the difference? In this video, I'll try to break down these complex ideas into simple explanations. Well, at its core, a trade deficit happens when a country imports more goods and services than what it exports. So imagine that the US is buying 100 billion in products from other countries, but selling only 70 billion to them. So 100 minus 70, that makes 30 billion gap in terms of trade deficits. But this number is not just about accounting. It represents real things. Here we're talking about cars, clothes, electronics that are coming in, and at the same time, fewer goods are going out. Some argue that this shows weakness, but Tatar says that it reflects economic strength and customer demand. Countries like the US run trade deficits because people can afford to raise more foreign goods. This raises a question. How is this difference financed? And does it create a problem down the line? To answer that, we need to have a closer look at the broader balance of payments. If a country buys more from the rest of the world than it sells, it needs to pay the difference somehow. But they cannot just send "I owe you" notes forever without giving something in return. That's where the capital account comes in. To balance a trade deficit, a country must attract money from abroad, meaning that foreign investors may be willing to invest on the country. So this can happen through the foreign investments that I just mentioned, selling bonds, or even letting foreigners buy domestic companies and real estate. Economists have a name for this. They call it capital inflow. In simple terms, if America runs a 30 billion trade deficit, it must receive 30 billion in capital inflows to cover the gap. Every trade deficit is mirrored by capital flowing in. But unfortunately, capital inflows are far from being free. They come with a lot of strings attached. Here we're talking about interest payments, profits sent overseas, or even foreign ownership of key and vital industries for a country. This means that every year a country runs a trade deficit. It sends wealth abroad, either in the form of promises to repay or outright sales of assets. Over time, this will build up. Foreigners start owning more of the country's businesses, real estate, stocks, and bonds. They earn dividends, rent, and interest, and, of course, they will send the profit back home. This is the wealth flow from a deficit running country to surplus countries. This is a phenomenon that will not happen overnight, but it will slowly shift control over the resources. All of a sudden, everything that is vital to run a country's economy will belong to foreign countries. While capital inflows can boost investment in the short term, they will, of course, increase dependency. Eventually, a country may find itself paying large amounts of income abroad, money that could have been allocated to fund schools, roads, or businesses. This is why some economists worry that a trade deficit today means a wealth outflow tomorrow. Like in other aspects of economics, it's difficult to have a consensus. So, not everyone agrees whether a trade deficit is harmful. Some economists, especially in mainstream economics, argue it's a natural result of economic growth and investment. They say that the US runs a deficit because foreigners trust its economy and want to invest in it. And that's an angle to look at it. Others, especially critics from heterodox schools or dependency theory, see it as a big red flag. They argue deficits hollow out domestic industries, send jobs overseas, and led to rising foreign ownership. Think of it in the following way. If a family in debt because it's investing in its future or because it's overspending? The answer depends on what's being financed and whether the returns justify it. Likewise, a trade deficit can be sustainable or it can mask deep structural problems. Tendency theorists look at it from a different point of view and they warn that trade deficits aren't just numbers, that they do reflect structural inequality in global economy. So they argue that wealth flows from poorer or weaker economies to richer, stronger nations, locking some countries into a state of dependency. But even rich countries can experience forms of dependency when they borrow from abroad or they sell assets to foreign investors. In the US, critics argue that large trade deficits let creditor nations accumulate leverage over American companies, land, and financial markets. Over time, this may erode economic sovereignty. Dependency theory then asks, who controls the production, the investment, and the profits? Running a trade deficit might look harmless today, but what does happen if creditors pull out or demand higher returns? Could it limit a country's freedom to act on its own interests? Employment is also a hot topic in economics, and this is also true when we relate it to trade deficits. When a country imports more domestic producers, they may lose customers. Factories will close, production will shift overseas, and local workers face layoffs. This is known as the process of deindustrialization. In the United States of America, critics link the trade deficit with the decline of manufacturing towns. While imports benefit consumers through the lower prices, they can devastate specific industries and regions. And those lost jobs aren't always replaced by equally good opportunities. The economists then debate how large this effect is. But there is an argument that trade deficits redistribute not just wealth, but also opportunities, meaning that people who work in industries exposed to import competition tend to suffer more. This makes trade policy not just an economic issue, but also a social and even a political one. Another important thing to make a note is that when a country runs a trade deficit, the costs and benefits aren't shared in an equal manner. Wealthy investors may benefit, they will have access to cheaper imported goods, foreign investment opportunities, and financial returns. Meanwhile, from the point of view of the workers in a declining industry, they will bear the brunt of job losses and wage stagnation. Over time, this contributes to rising inequality. In other words, trade deficits can redistribute wealth not just between the countries, but within the countries. Economists call this the distributional effect. It's not just a question of whether a trade deficit is good or bad in abstract, but for whom. A policy that benefits consumers overall might still harm factory workers or small producers. That's why trade debates often turn into political fights about fairness and who or which class deserves protection. A big question then comes to mind. Can a country run trade deficits forever? From a technical perspective, as long as a foreign investor keeps financing them, then we could say yes. But in reality, no creditor lends without limit. If confidence falls, or if foreign leaders seek higher returns, financing costs will rise. In extreme cases, countries face a balance of payment crisis, where they can't attract enough capital to cover the deficits. Even the US, with its privileged reserve currency status, faces risks if foreign appetite for its debt weaknesses. Persistent deficits will also increase income payments abroad. So we're talking about money that leaves the economy instead of being reinvested locally. It's like paying rent to a landlord every year instead of owing your own home. Well, to sum it up all, we could say that a trade deficit means a country imports more than it exports and must finance the difference through capital inflows. This will create wealth flows from the deficit country to surplus countries as foreigners gain ownership over assets and earn returns from them. Whether a trade deficit is harmful depends on how it is financed, who benefits, and whether it supports productive investment or if it is masking deeper structural problems. It's not just an economic number, it's a reflection of global relationships, power dynamics, and, of course, domestic inequality. By understanding these flows, we will gain insights into how the global economy works and what's at stake when trade imbalances persist. I hope you enjoyed the video and I hope to see you soon.